Chapter 7 is review of federal law in becoming a mortgage loan originator. Federal law is one of the largest sections that is included in the test and study of becoming a loan officer. And so, what I'm doing is I'm going to read a bunch of material that outlines everything, and then this video will serve as a resource that you can speed up and use while you're napping or relaxing or driving to get the information through. So the goals here of this is to recognize the federal law by its regulation when applicable. You will restate the major requirements of all federal laws covered in this section and identify the federal law by its key points. You will also apply each federal law and its requirements to the mortgage loan origination process and describe how each federal law interacts with mortgage loan originators. The first law is RESPA, which is the Real Estate Settlement Procedures Act. It is known as Regulation X. So RESPA or RESPA Reg X. And it was created in 1974. Its main purpose is to educate borrowers on the cost of their loans. The disclosures and notices required are escrow notices and the notice of transfer of loan servicing and affiliated business arrangement disclosures. Important terms related to this law are kickbacks, referral fees, escrow requirements, transfer of servicing, and it's enforced by the CFPB, Consumer Financial Protection Bureau. The Real Estate Settlement Procedures Act, implemented by Regulation X, was implemented in 1974. RESPA was enacted to protect borrowers in purchases, refinances, home improvements, and home equity lines of credit, and any other federally related mortgage loans. RESPA covers properties that are 1 to 4 family dwellings, condominiums, and manufactured homes. RESPA does not cover vacant land, large tracts of land, 25 acres or more, even if there is a dwelling on it, commercial or business loans, the government, its agencies or instrumentalities, or temporary financing, which is bridge loans or swing loans. Now, one test tip is you need to remember each of these federal laws, such as RESPA, by their full name, Real Estate Settlement Procedures Act, their acronym, and in some cases, or some situations, their regulation letter, Regulation X in this case for RESPA. In this situation, you need to remember that RESPA is the Real Estate Settlement Procedures Act, RESPA and Regulation X. It helps with those that have the regulation letters to make a device to remember them. A good one for RESPA is REXPA because RESPA's regulation is X. RESPA was created to help educate borrowers about the cost associated with the loan, which would lead borrowers to understanding what questions they need to ask when shopping for a mortgage loan. RESPA was also meant to eliminate kickbacks and referral fees that tend to inflate the cost of loans and limit deposits in escrow accounts to ensure the payment of taxes and insurance. Over the years, things have changed when it comes to RESPA and its disclosure requirements. The good faith estimate used to be a disclosure requirement under RESPA that outlined the costs associated with each loan and was required to be disclosed to the borrower 3 business days after receiving the application. RESPA also required the HUD-1 settlement statement at closing that even further and more detailed broke down the cost of the loan. In 2015, the TILA RESPA Integrated Disclosure Rule, TRID, was created that rendered the good faith estimate and HUD-1 obsolete on most transactions and created the loan estimate, LE, and the closing disclosure, CD. We will discuss TRID later in this course, but it is important to realize that RESPA was created specifically for the education of borrowers on the cost of their loans, and RESPA was created and to protect them through that education. Escrow accounts, also known as impound accounts. RESPA regulates escrow accounts, specifically the amount of money that is in an escrow account at any given time, the amount of escrow funds that can be collected at settlement, or upon creation of an escrow account is restricted to the amount sufficient to pay charges for taxes and insurances that are attributable to the period from the date the payments were last paid until the initial payment date. Throughout the life of the escrow account, the servicer may charge the borrower a monthly sum equal to 1/12 of the total annual escrow payments that the servicer reasonably anticipates paying from the account. In addition, the servicer can add an amount to maintain a cushion of no greater than 1/6 of the estimated total annual payment from the account. So 1/12 and 1/6. Before establishing an escrow account, according to RESPA, a servicer is required to conduct an analysis to determine the periodic payment and amount to be deposited into the account. The servicer must use an escrow disbursement date that is on or before the deadline to avoid the penalty and may make annual lump sum payments to take advantage of a discount. According to RESPA, a servicer is required to disclose an initial escrow account statement within 45 calendar days of settlement for escrow accounts that are established as a condition of the loan. The initial escrow account statement is required to include the monthly mortgage payment, the portion going to escrow, and an itemization of estimated taxes, insurance premiums, and other charges, along with the anticipated disbursement dates of the charges, the amount of any cushion, and a trial running balance. The servicer is required to submit to the borrower an annual statement for escrow for each escrow account within 30 days of completion of the computation year. At least an educated guess. The servicer is required to conduct an escrow account analysis before submitting an annual statement to the borrower. The annual escrow statement must include the account history, projections for the current year, current mortgage payment and portion going to escrow, amount of past year's monthly mortgage payment and portion that went into the escrow account, the total amount paid into the escrow account during the past year, amount paid from the account for taxes, insurance premiums, and other charges, the balance at the end of the period, and an explanation of how the surplus, shortage, or deficiency is being handled if applicable, and the reasons why the estimated low monthly balance was not reached. So you can do up to 1/6 in advance, or at minimum 1/12 of the annual escrow amount required. And escrow accounts handle hazard insurance and taxes for the most part. Transfer of servicing. So this is when mortgages get transferred from one lender to, like if they get sold to another entity. The borrower does need disclosure, so that's what this talks about with RESPA. RESPA requires that a mortgage lender or broker that anticipates that they may sell the servicing rights of a loan is required to let the borrower know that that may occur within 3 days after the receipt of application. So it's one of the upfront things that a borrower needs to know. The disclosure statement must advise that the servicing of the loan may be assigned, sold, or transferred to any person at that time. And I believe that it's a percentage. So if they sell 50% of their loans, then that's what they let you know if you're the borrower, you'll know that this entity sells up to 50% of their loans. Or if it's 75% or 25%, then you know that. When a mortgage loan is assigned, sold, or transferred, the former servicer must provide a disclosure at least 15 days before the effective date of the transfer. This is generally referred to as the goodbye letter. A letter from the new servicer must also be sent within 15 days after the effective date of the transfer. This is generally known as the hello letter. The letters must include the effective date of the transfer, the name, address, and toll-free or collect call telephone number for an employee or department of the first servicer that can be contacted by the borrower to obtain answers to service transfer inquiries. The name, address, the toll-free or collect call telephone number for an employee or department of the new servicer that can be contacted by the borrower to obtain answers to servicing transfer inquiries. the date on which the old servicer will cease accepting payments related to the loan, and the date the new servicer will begin to accept the payments. Whether the transfer will affect the terms or the availability of optional insurance, and any action the borrower must take to maintain the coverage. And then last, a statement that the transfer does not affect the terms or conditions of the mortgage. Once again, this is RESPA, Regulation X, Real Estate Settlement Procedures Act. And it's about disclosing certain things. And so far we've talked about escrow accounts and transferring of servicing. So now we're on one last thing on this. During the 60-day period beginning on the date of the transfer, no late fee or other penalty can be imposed on a borrower who has made a timely payment to the former servicer. So it's a 60-day safe zone that you will not be charged on when this loan gets transferred. Additionally, if the former servicer receives an incorrect payment on or after the effective date of the transfer, the former servicer must either transfer the payment to the new servicer or return the payment and inform the borrower of the proper recipient of the payment. So during the first 60-day period, it cannot be marked against them on their credit. But we need to prep the clients, prep the borrowers. They need our help. Section 8 of RESPA. So the number one reason loan officers screw up is this, or it was. Section 8 of RESPA was created to eliminate the payment of referral fees and kickbacks between parties in a real estate transaction. RESPA reconsidered legitimate business relationships and established the term and documentation required for affiliated business arrangements. An affiliated business arrangement is a person who may refer business to a settlement service of a federally related mortgage loan, such as a bank or credit union, FHA, USDA, VA, or an associate of such person, and has either an affiliate relationship with or a direct beneficial ownership interest of more than 1% in the provider of the settlement service. And either person directly or indirectly refers business to that provider or influences the selection of that provider. So if someone owns 1% or more of a company that you refer for business, then that has to be disclosed. The ABA disclosure must be delivered to the borrower at the time of the referral. An example of an ABA is a mortgage lender's CEO has an ownership interest in a title insurance company. If the mortgage lender's mortgage loan officer wants to refer their borrowers to use that title insurance company, then the relationship must be disclosed between the CEO of the mortgage lender and the title insurance company at the time the MLO refers them. Section 8 also states that no person may give or receive a fee, kickback, or any other form of valuable compensation, or arrange to do so, for referring a potential borrower to a certain lender or service provider for a federally related mortgage loan. Realtors that ask for anything in order to give you referrals is also out of the question. No one can either give or receive any portion, split, or percentage of any charge made for settlement service that is not actually performed. RESPA covers the costs associated with the loan, and it states that fees must be reasonable, but does not regulate the amount of fees. Section 8 does not prohibit the payment of a fee to an attorney for services actually performed, payment to a title company for services actually performed, payment to a lender or broker or services actually performed, payment of a bona fide salary, compensation, bonus, or payment for goods actually furnished, or for services actually performed. If someone violates Section 8 of RESPA, they are looking at a fine of up to $10,000, up to 1 year in prison, or both. They also may be required to make payment to damaged parties up to 3 times the original fee that violated the section And if more than one individual is involved, then all parties are liable to the damaged borrower, both jointly and separately. So, as long as you keep Section 8, you can keep your career and job forever, for infinity. So, that was Regulation X, Section 8 of RESPA. And now we're on to the next one, which is TILA, Truth in Lending Act, Regulation Z, TILA the Godzilla. Main purpose of TILA is to protect consumers from predatory lending practices. The disclosures and notices required are the HOEPA notice, Homeownership Counseling Notice, and the TRID. Important terms related to this law are high-cost loans, ability to repay, higher-priced loans, qualified mortgage, advertising, and right of rescission. The CFPB does regulate this. Air quality is garbage. My gosh. Truth in Lending Act is the oldest remaining piece of legislation regulating mortgages in the United States. It was first enacted in 1968 and is implemented by Regulation Z. It has gone through several changes over the decades, including many additions. Its purpose, though, remains the same, and that is to protect consumers. Regulation Z applies to any individual or business that offers or extends credit if the following four conditions are met. The credit is offered to customers or consumers. Credit is offered on a regular basis. Credit is subject to a finance charge or an interest or must be paid in more than 4 installments according to a written agreement. The credit is for personal, family, or household purposes. So, Regulation Z applies not when it's a business or a commercial deal. It's residential. Halloween is coming. Regulation Z does not apply to loans made for business, commercial, or agricultural purposes. A creditor is considered to have regularly offered credit if they extend credit more than 25 times in the preceding calendar year, or more than 5 times for transactions secured by a dwelling. TILA has a lot of rules that fall under it, and it is important to remember what falls under the TILA umbrella. So underneath TILA, you have the Dodd-Frank Wall Street Reform Act. You have HOEPA, which is Section 32, Home Ownership and Equity Protection Act. And then you also have the Higher Price Mortgage Loans, Section 35. Then under Dodd-Frank, you've got 3 subsections, which are qualified mortgage, the ability to repay, and LO compensation. So please note, Dodd-Frank is its own separate law, but the reason it appears in the hierarchy of TILA is because Dodd-Frank mandated that qualified mortgage, ability to repay, and LO compensation be created, and TILA is the law that these 3 now fall under because of their creation. Document retention. A creditor must keep all records of compliance with Regulation Z for at least 2 years after the disclosure date. Penalties are for anyone who gives false or inaccurate disclosure information, consistently understates the APR, or otherwise fails to comply with Regulation Z. That person can be fined up to $5,000 and be imprisoned for up to 1 year or both. So, when you break any TILA law or rule, you're subject to $5,000 and or a year in prison. With RESPA, it's a larger penalty. You've got $10,000 in 1 year, and you can have 3 times that if you commit multiple acts. So advertising. TILA covers any advertisement for consumer credit loans that involve credit offered to a natural person, credit that is being used for personal, family, household, or agricultural purposes, and payment for goods, and credit that includes a finance charge or must be repaid in more than 4 installments. An advertisement is anything produced with the intent to sell a credit plan, including newspaper and magazine ads, leaflets and flyers, catalogs, radio, TV or public address systems, signs or displays, billboards, point of sale literature, price tags, cash register receipts, internet, social media, websites, basically everything. Things that are not considered advertisements are rate sheets used for internal purposes, education, and state required material unless it is combined with a sales offer, and brochures that explain details about a mortgage if it is generic and does not offer completing a loan application. If a creditor advertises directly to a borrower, they are required to only terms that can be advertised are So if a creditor advertises directly to a borrower, they are required to do these things. And only use terms that can be advertised that the creditor will offer in credit plans. If a finance charge is listed, it must include annual percentage rate or APR. If the APR might increase after consummation of the loan, the ad must be specific on this detail. A simple annual or periodic rate applied to an unpaid balance may be in advertised conjunction with the APR, but not more conspicuous than the APR.